Good morning, everybody. This is Kevin Burgess again. Welcome back to the channel. This is my third video for YouTube. And I'd like to talk about two things today. One is I have some money to invest in the Dividend Growth portfolio. So I can invest $10,000 or $20,000 today, depending on which stocks I like. And so I thought what I would do is walk through my process on three different stocks. I've got Allstate, ALL, I've got Comcast, CMCSA, and I've got Johnson & Johnson, JNJ on tap today to be reviewed to improve my portfolio position. So thought I would go through that. And then secondly, I would mention to you that if you're new to the dividend growth investing community, I think what you'll find is that this community is a supportive community. We help each other because our success doesn't come from convincing somebody to invest in the stocks we're investing in. Our success comes from the ability of management of those companies to convert their capital into solid dividend growth opportunities for us. So with that, let's get started. I do take your comments and your feedback seriously. I appreciate any feedback that you give. My new friend Zachary told me I needed to relax a little bit, just be myself. And I think that's excellent advice. So I'm going to take that and I'm just going to be myself, not going to be so worried about, making sure that I say the right things at the right times. I'm just going to just speak from the heart. And so I think that'll be good. And I think in the last video there, I forgot to say, grab your coffee and let's get to it. Okay, so let's take a look first of all at Johnson & Johnson. I've gone ahead and pulled up the websites that I use, and I've gotten Johnson & Johnson pulled up, so hopefully it'll make the video go a little faster. But I thought I would share with you that this is going to be again in my high growth dividend portfolio. So these are stocks that I'm less concerned about the yield and probably more concerned about their dividend growth moving forward. So I want to show you kind of why I picked these three stocks. In my portfolio, I am down 13% at the moment on Allstate. I'm down on IBM as well. I'm not looking at them today just because there's so much going on with the spinoff, and I just don't know if that's it would take a video just in and of itself to look at IBM. So the next lowest performer I have is Comcast, and then the third lowest, or the fourth lowest, I guess, is Johnson & Johnson. So I want to look at these three, Johnson & Johnson, Comcast, and Allstate. And basically what I plan to do is to invest in maybe one or two of these and try and bring this average cost down to average down. So let's take a look at Johnson & Johnson. This is Simply Safe Dividends. It's one of the services I subscribe to. You can see that Johnson & Johnson's dividend is very safe. It's rated a 99, and that's the highest rating that they have. Their dividend yield is about 2.58%. And over, well, let's look at, I'll get to the dividend growth here in a second. Their beta is 5.51. which is about half of the volatility that we would see in the market. So, all of that looks really good. And as everybody knows, Johnson & Johnson is one of the best and premier dividend stocks in the world. So let's move on then to dividend growth. And as you see here, over the last 5 years, they have grown their dividend by 6% per year. And in the last 20 years, it's grown 10% per year. The latest was a 5% growth. So you can see that they have consistently, look at this line. It is just up and to the right, and it is just a beautiful, almost a straight line. They have had a dividend growth streak of 58 years, and as well as a dividend streak of 58 years. So every year that they've given a dividend over the last 58 years, it has grown year over year. So what else can you say, right, about Johnson & Johnson? Looks really good. From a valuation perspective, its yield is a little bit under where it typically is, but not much. I guess here it says the 5-year average is 2.64 and it's running at 2.58 right now. So from a valuation perspective, it's pretty consistent with where it's been the last 5 years. The forward PE is roughly in line also. When we look at the financials, the earnings payout ratios are, in the, we had in the year of COVID here, a 50% payout ratio, but looks like it's getting back into the low 40s, and that is a fantastic place to be. You can see that their free cash flow also does well. Their earnings are up and to the right, so that's fantastic. Their shares outstanding are going down slightly, but not a lot. Their sales up and to the right. So all of that looks really, really good. Operating margin is 26%, which is incredible. So, and then their interest coverage, 114. So it's almost like they don't have any debt. So with their debt to capital is 0.09. So Johnson & Johnson, from that perspective, looks very, very good to me. Looking at Fast Graphs, which is another service that I subscribe to, you can see this is Johnson & Johnson over the last 8-year period. And these green dots, I actually input my portfolio into Fast Graphs. These green dots represent the purchases that I've made, and it doesn't really distinguish between dividend reinvestment and a real purchase. But you can see that I bought in at 175, 174, and then 167. And somewhere in here, and I can't find it, is dividend reinvestment. However, today, we're still sitting at 164.27. This blue line here is indicative of a PE that is comparable to the historical period, that we're looking at. So looks like it's within, a tolerable range. It's not, a highly undervalued company by any means, but I don't know that it ever will be. I mean, if you look back at, the last 20 years, it was undervalued back in the 08, 09 timeframe, even through 12. But then once after 2012, I mean, it has come back to the 15 times PE line. But here lately, it's just been way above even the blue line. So, but I like to look at about 8-year period just because it helps to factor out a little of the COVID impact when I look at it. So that looks pretty good. In terms of the forecast, their forecast is not growing tremendously, but it is growing. If I, invest today and it comes back at an 18% or 18 price to earnings ratio, could end up with a total annual return of about 10%. So that's not so bad. But it has to actually perform that way. The third thing I look at is Morningstar. I do also subscribe to that. And what Morningstar does for me is it not only gives me a robust analysis around the company that I'm looking at, it also gives me a discounted cash flows projection, and in terms of fair value. So they are saying that the fair value of Johnson & Johnson is 167, and today it is 164. So it's not certainly at a discount, but it is certainly within a fair value. The last thing I would look at is Seeking Alpha. A couple of things I look at here. One's the quant rating, which basically says it's neutral, and a lot of that relates to the valuation because it's not undervalued by any means, but it's also not tremendously overvalued. So growth potential, they don't see a lot of growth there, although it looks to be consistent to me. It's just not very fast. The other thing I look at here are the Wall Street Analysts ratings, and the Wall Street Analysts are bullish on it, but more importantly, there's a price target here of 186. That is only worth the paper that it's printed on, but it does give a range of what the experts on Wall Street believe the stock's going to do in the next near term, maybe the next year or so, which is they're from a low of 162 to a high of 215. So if we get in at 164 and worst case scenario, which is never true, but would be 162, we're not really hurt that bad because we're also going to be getting dividends out of it. So Johnson & Johnson looks actually pretty good. So now we'll move on then and look at Allstate. Now, before we move on to Allstate, something I failed to mention earlier is that I am not looking at these stocks for the first time. So I'm not looking in depth at the company and what their products are and what their capabilities are. I've already done that analysis and have actually invested in them. So this is really more about comparing one stock to the other and trying to figure out where to put the next investment of money. So, and before I forget, just a reminder that I am not an investment professional. This is not intended to be investment advice. This is strictly for your entertainment purposes only. And if you do enjoy this video, please hit the like button below and click on the bell and subscribe to the future videos. And that would mean the world to me if you would do that. I really appreciate it. Okay, so with Allstate, let's start again with Simply Safe Dividends. Allstate is with a dividend safety of 80, so that's pretty good. Not as good as Johnson & Johnson, but it's still pretty good. So if you look at the dividend yield, it's about a 2.84%. Interesting, the dividend growth shows a 50% increase in dividend in February of 21. So that's obviously a very good sign. Moving on to their dividend safety, their payout ratios look really good, 18%, 31%. We'll look at those in a little more depth here in a second. Debt to capital is reasonable. And dividend growth, here's the kicker. So dividend growth, there was a cut in dividends back in 2009. And those of us who lived through that period will recognize why that occurred. But since then, it's been a pretty good move upward. The dividend growth rate for the last 5 years is 12%, last 20 years is 6%, but the last year was 50%. You can see that here, that in the April dividend payment, they went from 54 cents a share to 81 cents a share. Pretty big jump in dividend. Their current yield is 2.84%. This is above its 5-year average, which is 1.97%. Not surprisingly, because they raised it by 50% roughly. So it's just interesting that the PE ratio is the same, very consistent with the 5-year average, where the yield has gone up dramatically. Let's look a little bit at the financials. Their payout ratios is really good. It is jumping up, but it's because they increased their dividend by 50%. So you can see that reflected also in their cash flow. Their earnings per share seems to be struggling a bit, and we'll talk about that in a few minutes. Free cash flow looks pretty good. Let's see, shares outstanding. They have appears to have a consistent share buyback program. You can see in 2011, they had 523 million shares. Now they have 304 million. So their sales are growing up and to the right. Their operating margins are decent, and their interest coverage is really good. So looking at all of that information from Simply Safe Dividends, makes us feel pretty good so far about Allstate. Moving on to fast graphs, what we find out here is that according to fast graphs, the Allstate stock is significantly undervalued. Based on this 8-year look back, it is well below the normal PE ratio of 12. So we're trading down around 8.32 at the moment. And, so it just appears from fast graphs, it's extremely undervalued. The forecast, let's look at that real quick. Forecast shows earnings coming down and then slightly going back up again. However, if they can get back to a blended PE of, whatever that was, let's say 12, then, we're talking about a 20% rate of return on an annual basis. So, that's interesting. Let's check and see how well the analysts do at predicting Allstate's earnings. They basically miss it half the time, they beat it half the time, and then they hit it only just a small part of that time. So probably not a great record for forecasting from the analysts. So not really sure how much stock we can put in these forecasts, but it's what we have. We can't invest in the past. We can only invest in the future. So let's move on then to Morningstar. When we look at Morningstar, there's one thing that we should point out here. Their analysis, their discounted cash flow, it calculates fair value of 114. The last close, which was yesterday, it's 114.11. So it seems to be at the Morningstar fair value. So let's talk a little bit about what's driving the growth issues. So it says here, Allstate had a difficult third quarter with profitability hit by catastrophe losses and negative claims trends across its business lines. So they were expecting that coming from the COVID-19 pandemic. They're maintaining their 114 fair value because it's not materially different than what they were expecting. From a long-term perspective, and this is something that we should consider, we remain concerned about the lack of underlying growth in the company's core operations as the captive agent channel continues to lose share. So basically, the folks at Morningstar are a little concerned about the long-term lack of growth at Allstate. So that's something to consider. Let's look on to Seeking Alpha. We find the quant rating again as a neutral, similar to what we saw with Johnson & Johnson. The reasons are different. The valuation appears to be pretty decent from a Seeking Alpha perspective. The profitability is good. However, growth potential's pretty slow. Momentum and revisions are D-. So that's what goes into these ratings. And at the end of the day, valuation and profitability are probably the two that I like the best. Growth is also a factor. So we will, that's obviously an issue for us. Moving on then to the Wall Street analysts, they are bullish at 3.56. So that's actually good. The price targets that these Wall Street analysts have are the high is 176, the low is 114, and the average is 136. So this is not a discounted cash flow analysis. It's basically these analysts determining where they think the price is going to go. The good thing here is that the price is sitting currently at 114. So all of the analysts believe that it's going to be at this price or higher moving forward. So that's a good sign. So that's it for Allstate. Now let's move on and look at Comcast. So with Comcast, we find that with Simply Safe Dividends, they have a safety rating score of 89, which is really, really good. We have a dividend yield of 1.85%, and their latest dividend showed an 8.7% growth rate. Their beta is a bit volatile. They have 1.1, so a little bit more volatile than the market. Moving on then to Dividend Safety, their payout ratios really look good. They're in the low 30s, high 20s. They have a high debt to EBITDA, but their net debt to capital is about 48%. So that's certainly not bad at all. They have a dividend streak of 12 years. Let's move on to this section here. So as we talked about, they have their latest increase was in January of this year at 8.7%. Their average for the last 5 years, the compound average growth rate or annual growth rate, the CAGR, is 13%, pretty significant. Then over the last 10 years, it's 17%. So it's slowing a bit, right? It went from 17 over the last 10 years to 13 in the last 5 to 8.7 in the last year. But I mean, as they have a higher and higher dividend, that's going to be harder and harder to keep those percentages up in that 17, 13 range. So that's interesting. So they've paid a dividend for 12 years. And they've had a dividend growth streak for 12 years. So every year they've increased their dividend for a 12-year period. And, you know, you can see this, their valuation, their dividend yield was roughly the same as their 5-year average. Their PE ratio is just a little bit lower than the average, but that's not concerning. Let's look at some of the financial metrics. They have a great payout ratio. For both cash and earnings. The earnings per share, while it had a bit of a dip for the COVID period, it does appear to be up and to the right. The free cash flow is similar, and shares outstanding are coming down, not as significant as what we saw with Allstate, but they were at 5.56 billion shares back in 2011. Now they're at 4.66 billion shares. I'm not even sure I can count that high. Sales are up and to the right. The let's move on. The operating margin, 18%, really good. Free cash flow looks good. The net debt to capital, again, is 0.48. The interest coverage is 4.74. I'd like to see that a little bit higher, but you know, I think that's certainly a manageable number. Let's look at fast graphs for Comcast, and what we see here, and you can see that I've bought all along when it was above this blue line, which, as I learned, you know, one of the things I talk about is I want to share some of my mistakes, and some of my mistakes are buying companies that are really good companies, but buying them possibly at an inopportune time. And so we see that here with Comcast. I mean, I bought some at, you know, 58, 59, then it dropped, and I bought some more at 55, and now it's dropped again, and that's a dividend reinvestment there. But and so we're back to 54, and so the question is, you know, should I buy now? You can see the blue line here, though, is going up tremendously, and that has to do with the forecasted growth for earnings for Comcast. So I would say that it's a good time to buy, because if you buy here, that average cost is going to be a good return. So let's look at that. Let's look at the forecasting piece of this. So if we look at this, we're currently at a 17.52 blended PE ratio. If in 2024, if we continue at that 17.5, that's going to be somewhere between these two numbers. So somewhere between the 16% and 19.5% rate of return on an annual basis. That's obviously if the stock price follows the earnings projections, which ultimately it will, but it does go below and it does go above. And so the market is not a perfect picture of the value of a company. So the idea here is that we want to pick the right values to invest in. So let's move on then and look at Morningstar's analysis. They have them with a fair value at $60, and the current close was $54.17. That's about a 10% premium, I guess, or a discount to their fair value. So that's the first one we've seen thus far that's been at a discount. Then lastly, we'll look at Seeking Alpha. The ratings, quant rating is very bullish, and you know, they focus is the profitability is excellent, valuation, and I'm not really sure why they rate that a C, because the valuation, everything I've seen says that it's undervalued. But then the growth also is kind of middle of the road. But it looks to me, one thing we didn't do on fast graphs, let's look at that real quick, is, we did do that. Never mind. I was thinking we didn't look at the growth, but we did. So then lastly, on the Wall Street Analysts rating, they're very bullish, again at 4.36. Their price targets, interesting, average price target is 65.93, low of 46. So some analyst out there is very bearish on Comcast and is saying that the price target is going to 46. We're currently at 54. So he's saying, hey, you could lose 10 to 15% of your investment in the future. The average is 65.93. The high is 75. So, it actually, to me, looks pretty good. So now what do we do with all of this? Let's talk about then how we kind of make a call here. So from my perspective, when I look at the Morningstar ratings, all of these stocks, all three of them are either at or below the fair value calculated by Morningstar, with Comcast being the most below. The interesting with fast graphs, when we look at Johnson & Johnson and Comcast, they're pretty fairly valued, but Allstate is significantly undervalued in those scenarios. All of them have great financials. They have very good payout ratios, et cetera, et cetera. I wouldn't invest in them otherwise. So I kind of know part of the story here before I even go down this road. And again, I'm comparing the investments that I already have that I'm very comfortable with. So I think for my next $10,000, I'm gonna go with Comcast. And the reason I picked Comcast is mainly because of the Morningstar rating, where they are saying that the value of this stock is about at a 10% premium. I'm sorry, 10% discount when you look at it. So I think that's my first 10,000. I do think I'm going to invest the second 10,000, which would then go to our friends at Allstate, because they appear in fast graphs to be so significantly undervalued in the charts. So I think that's a good thing. So I'm going with two stocks today. I'm going to buy Allstate and I'm going to buy Comcast. And what that will do in my portfolio is I'm going to go to the high growth portfolio here and again, sort this by gain or loss, focusing on the losses. It's going to help me a bit in averaging down in Allstate, because $10,000 investment out of a 31,000, so it'll come down to about a third. So I'll probably end up with between an 8 and 9% loss here. And then with Comcast, another 10,000 would be about a 50% increase, which would take me down to about a 3% loss on average here. So that'll improve my position in both of those, and that's where I'm going to go. If you disagree, I want to hear your thoughts. Maybe I should have gone with Johnson & Johnson. Maybe there's some others that I should be looking at, like Lockheed Martin, for instance. But it just hadn't lost enough to have a significant impact on averaging down for my portfolio. So if you got thoughts, maybe you agree with me, maybe you disagree with me on these three stocks. Maybe there's something else I should have chosen. Be glad to hear from you. Just give me some comments in the notes below, and look forward to having that conversation. Again, the Dividend Growth investment community is a tight-knit community, and we're here to help each other. So anything I can do to help, be glad to do that. So thank you for your time, and go enjoy that cup of coffee. Talk to you later.